These 7 scalping rules that I'm going to talk about have completely changed how I trade, and I'm very confident if you implement all 7 of these points, you will start to see a difference in your trading where you will take smaller losses and you will make your wins compound. Now, we have to understand one thing about this because it's going to be the premise of the market, and I think it's a very important concept about how us as traders need to view the auction and view the stock market. Now, this is in a book called The Money Game by Adam Smith. And in this book, I was reading over the weekend, he says something that is so true, and you have to know this and accept it for you to see the market differently. He says, the market is like a beautiful woman, endlessly fascinating, endlessly complex, always changing, and always mystifying. There's always something unknown and undiscerned. Now, in the market, it's the same exact way. The market is endlessly fascinating. There's a million different variables that affect if the market's going to go up or down. It's complex, it's always changing, and it's always mystifying. Our job as traders is to read the information the market provides and accept how complex and fascinating it is and go with the flows of the market, essentially going with the flows and being fluid like water. That when the water changes and the water's going down the stream, we go down the stream with the market and we never go against the market. If we try to go against the market and we aren't fluid, that's when things are going to hit the fan and we're going to take a lot of large losing trades and not take good winning setups. So the first rule I want to explain is to never marry a setup, never marry an idea, and remove your bias in the market. Now, my biggest mistake when I first started out trading is I would just get in or out of the market because of an idea or a setup that I thought was going to occur. I had a bias because it didn't make sense for the market to be at the prices that it was at. In this example, on the S&P 500, we had non-farm payrolls today getting released. Data before the market opened came in hot and the market aggressively sold off from this data. Now, picture this. You spend 2 hours the night before the market opens, that you plan all the setups and you have your levels on your chart. Oh, I'm going to trade SPY when it hits $520, or I'm going to sell SPY when it hits $530. And you create these plans the night before the market's open. And when the market is open, you want to be correct and you want to make money because you just spent 2 hours the night before trying to become perfect and trying to predict where the market's going to go. If you marry an idea or you marry a setup and you don't let it go, then you are not changing with the market and you are going against the tides. And that's going to be the recipe for a reversal in your account if you do not go with the water and fluid like the flows. In this example, let's just say you had a bias to take the market short when it broke under this green level of demand. I planned for it the night before that as soon as it breaks, I am going to take it short. The market breaks this level and we don't take it short because we don't see best confirmation yet. But then we begin to see a rally and now we are so short bias because our level broke and we are expecting the market to come down, especially that the news came out hot. I'm biased. The market's selling off. The job report is really weak. The economy's going down. COVID just hit. Let's keep selling this thing and it's going to shoot all the way down and I'm going to make a lot of money. If you go into the market with a bias and you don't listen to what the market's telling you, not only are you going to take bad setups that could be avoided, but you're also going to miss the truth and you may miss great setups because you married an idea or you married a setup that you ignored the facts the market was providing you in real time. Now, that's not to say to not have a bias in the market. I'm talking bias on a mental side based off of your analysis, that you're letting your emotions do the trading. You can have a bias based off of structure and based off of price action, because in this example on the S&P 500 today, our bias was to only look for buyers above 53, 55, that I do not want to get bearish above a level. So there are levels in the market that, hey, we wake up, we plan all these setups that if we're above X level, then I have to remain bullish. Or until this level breaks, I'm going to remain long bias. In this example, our level was 53.56 today, that the market, if you've remained with this bias, you would not have been caught off guard in the market, especially when the market dips and holds the level and then rallies off of that. So you can have a bias based off of structure, but having a bias based off of where you think the market will head is not a good idea. And if you have analysis and the market's telling you to do something else, stop marrying it, dump it. It's like a bad girlfriend. If she's not treating you well, why would you stay with her? It's the same exact thing in the market. The market's not treating you well or not going with your analysis, dump it and look for new analysis. My job as a trader is to react, and it's not my job to predict. I don't know where the market's going to go. I can't predict if it's going to move up. I can't predict it's going to move down. But because of how complex it is and how fascinating the market is, and it's an endless stream of information it's presenting to us as traders, we have to read that information and react to that information. That way we can come up with trading scenarios. So this setup I want to go over on the S&P 500 is going to be the basis to other examples. And this was about a $16,000 profit off of a $2,000 risk. I never know how I'm going to trade the market. I never know what I'm looking for until the market tells me to watch it, and until the market tells me that buyers or sellers are present. So in this example, the main thing that we were watching here on the S&P is this level at 53.11 to 53.05, which is marked by this green box. And this was before price action was trading there. It was a key level based off of the day prior. The market sells off into this level, and I was interested in buying the pullback into it. The market dips down, and around 10:10 Eastern time, I take the market long off of a 2-point risk. Now, the reason why I'm saying this is because a lot of traders wake up, going back to the previous example, is they plan all of these setups that, hey, as soon as Tesla comes to $300, I'm going to buy the breakout. Or, hey, as soon as the S&P hits 53.11, the demand zone, I am going to take it long. If you sit there and say that, you are trying to predict. Us as traders do not have the information the market's providing us until the market provides it to us at that level of interest or at the setup that we are looking to trade around. So we have to react to information in that present moment of real time. In this example, the market dips down into this level. It's not saying, hey, as soon as we come into this level, I am going to take it long. Because what happens if you come into this level and the market extremely dumps, and you getting in just because it's at your level and you're trying to predict it going up causes you to sit in a really large losing trade. A good example of reacting instead of predicting is number one, coming up with the level of interest. In this example, we can see I came up with this level of interest before price has traded there. And step number two is see the type of action when the market comes down to your level of interest. In this example, the market sells off into demand at 10:10 Eastern time, which you can see here by this lower wick. And if I were to pull up a time in sales, what you're going to see here is outliers in the data of really large selling pressure at 10:10 Eastern time at 53.10, 53.11, right at our key level. So now we're using this new information that we did not have previously, and we are formulating a thesis around it, because now the market tries to move up, pulls back, and we hold 53.10 perfectly. This level of defense is me reacting, saying, hey, there may be a large buyer present in the market, and I did not have this information before, and I could not have came up with this plan, and I couldn't predict the market trying to bounce here, but I'm seeing this buying activity here, and let me try taking a stab at this thing long. And this is exactly what I did, as it offered a 2-point risk for a 20+ point reward to the upside. And this thing rallied and bounced perfectly right into our target of supply. My next rule is to locate opportunity, not try to create opportunity. Location versus creation. My job as a trader is to locate the setups that I know work out for me the best. In this example, seeing trapped sellers at a level of demand, seeing large buyers defending price is a setup that I am looking for on a daily basis. A lot of traders get it twisted backwards, and they try to create opportunity because they don't know how to define opportunity. What I mean by that is a lot of traders will just see the market coming down. Hey, we're putting in lower lows, right? So we could see a high here. We could see a lower high here. We could see a lower low here and some more lower lows for the rest of the session. So they see this lower low, lower high. They say, hey, the trend is bearish intraday. It's coming down. I think we're going to keep selling off. And this thought or this thinking is you trying to create an opportunity, but the opportunity was never present because the setup was never there. So my objective is to locate my setups because I am locating the opportunity around those setups. My job is to not create setups or create opportunity based off of false assumptions of where I think the market's going to head. Let's say you see the market coming up here and you say, it doesn't make sense for the market to be this high. Well, I'm going to take it short. You are creating opportunity because you are not finding your setup. If you put yourself in the position to locate your setup versus creating a setup, then you are putting in yourself the position to take high quality trades where the probabilities are in your favor, where you're going to take really large wins and small losses. A lot of people always ask me, hey, Carmine, what do you look for when the market's at your demand zone, or what kind of confirmations are you in search of? And I cannot give traders that answer because I don't know what I'm looking for until the market tells me what I should be looking at. So the way I look at the market and the way I want everybody else to look at it is you need to define what opportunity is for you in the market. For me, opportunity is the market coming into my level of interest, let's say this demand zone, and I spot trapped sellers, I spot large buyers defending price, or I spot, let's just say, a new demand zone forming off of this old demand zone. I am locating opportunity. Now, once I have this opportunity, I need to realize the probabilities backing the market. What's the context? How is the volume? What is the range? Are we inside of yesterday's range? Are we inside of the pre-market highs, pre-market lows? I need to define how the probabilities are stacking against me or with me when I define that opportunity. So now I've located opportunity at the demand zone. I'm seeing buyers defend price here. The risk is in my favor. This is a trade that I have to be entering. If I locate the opportunity, but the probabilities are not so much in my favor, I will either size down, sizing down always helps, or just not take the trade and look for a different opportunity. But when I have opportunity and the probabilities are in my favor, I am taking the setup. There was another example where the market hit my level of supply and I saw opportunity there, but I did not take this setup short because the probabilities of stepping in front of this strength was slimmer. Now, I could have sized down and this would have worked very well on me and I would have made profits, but I wasn't comfortable taking it despite me locating opportunity because the probabilities were not in my favor as the market was at all-time highs. And shorting an all-time high is something that I do not advise, especially when there is zero downside pressure or zero shorts built into the market. So yes, opportunity is found here, but the probabilities were lower in my book, and I will either sacrifice a lower position size or just not take the setup like I did today. The biggest thing for me is getting rid of hesitation, because hesitation enables you to have poor risk to reward ratios. And the only way you can get rid of hesitation, and the way I've overcome it, is defining the setups, defining my opportunity, and knowing what works out for me the best due to many years in the market, many trades, testing, back testing, journaling, reflecting, reviewing. So I know what I'm looking for on a daily basis. So when I see it, I'm not hesitating because I know that's what's going to work for me in the long run. The problem is a lot of traders will find opportunity, they will see the market trigger, and they won't take the trade because they are fearful to lose. So if you hesitate, it is better off for you to not take any setup. In this example, when I got long down here at the low, if I waited any longer to get into this setup, let's just even call it maybe over here. If I waited over here to get long, what that's going to do is if my stop loss is at the low of day, now my risk is much larger placing my stop loss at the low of day versus getting in at the green arrow, my risk is much smaller. So if you hesitate or you delay your entry, the trade could still work, but now you are sacrificing a lower risk to reward ratio. And our job is to trade with higher risk to reward ratios so we can be incorrect more than we are correct, yet still come out green and still come out profitable. So if you delay your entry or you hesitate, it's best to not take the setup. As soon as you see confirmation, take that trade. Don't think about where the market's going to go next. Don't think about how much you're going to lose if you're wrong. Take the setup, because if you hesitate, number one, you might miss the best opportunity. The market may not ever revisit that area. And you're also just going to completely lower the amount of profits that are in your pocket and raise the money that's going out of your pocket if you are incorrect and you take a losing trade on that setup. I said this in Invest the Trade today, and this is a very important concept, that more fear equals less profits and less fear equals more profits. Less thinking is more profits and more thinking is less profits. How many times have you thought about a setup? Is this going to work out for me? I might lose on it, but I can't really afford to lose this much amount of money. You're thinking too much. You have too much fear. And if you think and you have fear, you are going to make less profits because, number one, you might not take the best setup that's right in front of your face, but also fear, when it creeps in, is going to make you make emotional decisions, and your fear is going to do the trading for you, and it may blind you from the truth and make emotional decisions that you may get out too early, you may get out too late, and it's just a domino effect on your account that's just going to make you take losses which could have been avoided. So have less fear. Approach the market with confidence. Stop thinking so much. Stop thinking if it's going to work out. Stop thinking if you're going to make the right decision by buying or selling. Just do it, because when you just do it and you jump head first, that's when you're going to start making more profits, as long as you can manage your risk when you are incorrect. And also, if you want to become a better trader or a better scalper, size down. When you're developing your edge, you need to size down. When you're making emotional decisions, you need to size down. When you're trying to decrease the amount of fear in your trading, you need to size down. When you are thinking too much, you need to size down. Take 2 seconds, pause this video, and read what I wrote here in the Invest the Trade community. A lot of traders need to size down. That it will help you solve emotional problems, it will help you solve data problems, and it will help you take better setups when you can cut down your losses, because you won't be emotionally attached to the market. So pause this video, read this if you need to, take this advice to the heart, because I'm very confident if you listen to all this, you will see a major difference in your trading. On that note, I'm going to end this video. If you got any value out of it, I would appreciate a thumbs up, comment any questions, and if you're new to my channel, I would appreciate it if you could subscribe. Peace out.